So it's Thursday, March 26th, 2020. Going to look at Chapter 8. Going to talk about Chapter 8 a little bit. And then look at about 8 of the multiple choice questions at the end. Then I'm going to cut you loose and let you kind of do your thing. It's not a very super long chapter. It's an important one. It's got a lot of different little topics. It is the acquisition and expenditure cycle. Now, don't get that confused with governmental. If you're in the governmental class, it is not the same thing there. We're talking about expenses, and we're talking about the purchasing process, corporations or publicly traded companies. So before we begin, though, let's do a quick devotion. I got my little secret place book here. Thanks to my mother-in-law, and we do a little daily devotion. We'll do that right now, and then we'll jump into chapter 8. All right. So here we go. What an amazing! This is from Cindy Lee. She lives in the United Kingdom. What an amazing job you have, I thought, when I saw a woman and her Labrador each day on my way to work. Imagine training guide dogs to become accustomed to traveling on trains. Every morning, this woman would commute on the train and whisper loving words in the dog's ears, and the dog would capture the hearts of all us, and the young woman chatted to the passengers about her dog. Several months later, I was going home on the train. One evening, I noticed the woman staring into her phone with a magnifying glass. At this point, I realized the dog wasn't hers. The dog was hers, and she wasn't training the dog. I had completely misinterpreted the situation. My misconceptions meant I had made assumptions that were incorrect. How often do we misinterpret situations? Sometimes we only see what we want to see and are completely blind to the things that we don't wish to see. So a good little message there. Obviously we don't want to judge, and she made an assumption early on, but the good thing is she didn't seem to be judgmental after the fact when she realized the woman in fact was visually impaired. Anyway, so chapter 8 of the text is on again. It's acquisitions and the expenditure cycle, which really we're talking about. It's not governmental, so it's not the expenditure in terms of governmental class, but it's really expenses. Looking at different expense accounts. So obviously the relevant accounts here in terms of what accounts are going to be involved. Well, we know when we do purchases, we're talking about cash. More specifically, we're going to have disbursements of cash. So cash disbursements journal or credits to cash. We also have accounts payable, and then we could have a number of other things. We could have fixed assets if we're acquiring long-term assets. There could be purchases here of merchandise inventory, or there could be just paying expenses. So there could be a whole lot of other accounts involved where these debits would go, whether we're adding to fixed assets or whether we're adding to maybe like a payroll expense, or we're adding to repairs expense, or adding to inventory. So let's start off though by talking about the process. The typical process of ordering, or let's just say ordering some equipment. I don't know what to say, equipment. We're going to order some items that some people need. Now I hear my dog's barking, so we might get some barking going on. So it all starts off with essentially a supervisor of a department realizing that they need something, okay? Maybe it's something as simple as office supplies. We need to order some office supplies. So in this case, you would have the supervisor would make a requisition, purchase requisition. I know we're not quite to a purchase order yet. Usually you have people that are specifically, their job is dealing with purchase orders. So you're gonna have it's gonna start with a requisition, and then at that point it would get filled out on a pre-numbered purchase order. Now we want to keep that separate. That should be separate from separate from the people that do the requisitions, because we don't want people just ordering stuff at their own discretion. It needs to come from an actual need, right? That would be best, at least. So once we have the purchase order, then you'd have people in charge of making the actual purchases take over. They would want to make sure that the person or the company we are buying goods from are approved vendors. And once we have an approved list of vendors, then we would say, okay, we're going to order from these people. We would go ahead and put in the purchase order. At some point, the goods will arrive, and we would have a receiving report that would go with those, and also an invoice from that vendor how much we need to pay. And so once we have all those pieces of the puzzle, the requisition, the purchase order, the vendor's invoice, the receiving report, okay, at that point we would have like a full package of documentation. And at that point we could prepare the check to pay them, okay? So that's essentially the process. Obviously, once we get the invoice, we're going to generate an accounts payable, and the other side of that will be a debit to potentially an asset account or an expense account, obviously, right? So let's talk about, while we're at it, we'll talk about accounts payable, okay? On page 342, relevant assertions, okay? Relevant assertions is always important in this text, is, which ones are the most important. The two relevant or the most relevant assertions for accounts payable are completeness and cutoff, and those do go hand in hand. If you look up completeness, usually directed below it is cutoff, and those are high, okay? We want to make, if you think about it, it makes sense, right? Because we want to make sure what's complete to say that everything that is recorded, everything that should be recorded is recorded. And then cutoff is it's in the correct period. Well, if we're trying to make our liabilities look good, okay, well, it would make sense that we would not record some. So it would say, well, yeah, this invoice says December 31st, but let's just put it in there on January 1st, and it won't be in there as expense. So we'll have lower liabilities, we'll have lower expenses, we'll have a little bit higher income. Now, it'll work itself out next year, but this year we'll look a little bit better. So that's why cutoff would be so important with completeness. Now, there's several other important assertions. There's quite a lot for accounts payable. So once we get past the two high assertions, or the two high risk assertions, I should say, make myself a little bit smaller here. We get into something a little more moderate, okay? And those would be existence, rights and obligations, and then valuation. And then, so this is going to bring us up to our question for the chapter, which it's on Blackboard again for you to fill in. I got my little whiteboard filled out. Okay. So accounts payable, we got essentially five assertions. The two that are high, or the high risk ones, are up here, completes and cutoff. And the ones down at the bottom, the three down below, which is usually this is existence right here, valuation right there, and then over on the other side, really it's obligations, okay? Because rights applies to assets. Okay, so let's talk about these a little bit. And that's your question for the chapter 8, is to list out the 5 assertions and make sure you put a note in there which of the 2 of the 5 are the high risk ones, which is completeness and cutoff, okay? And that is on page 242 of the book. You can find that at the top of the page. All right. So let's look at existence first. Okay, existence isn't a very important, isn't a super important assertion, and it kind of makes sense if you think about it. Hold on, let's train of thought there for a second. So existence is very important for accounts receivable, which makes sense because we want to make sure that the actual, for accounts receivable, we want to make sure that that amount that's owed to us actually exists. Well, not many people are going to make fictitious expenses with fake liabilities. Okay, it just doesn't work in their favor for the most part. You're going to understate income. You're gonna throw out of whack your debt to assets to debt ratio, whatever. You're gonna mess up your quick ratio. So for the most part, you don't see a whole lot of fudging to try to put in fake liabilities and fake expenses. And that's why it is on the list, but it's lower on the list because of that reason. But what makes obligations, which is rights and obligations, much more important here is you may see where where employees are trying to send fictitious expenses through the system. That way, they might set up a dummy vendor, which would be very hard to do if you have a good internal control or you have an approved vendor list. But if you had a fictitious vendor, maybe you had it go into a PO box. You can send in fake invoices. The company's paying it. Then you would go to your PO box and pick up these checks, cash the checks, and be defrauding the company. So we want to make sure that the accounts payable that are listed are actually obligations of the company. They're not fake, and they're not the obligations of maybe you got the CFO or somebody's trying to run through some personal expenses. So there may be some accounts payable that are not listed to companies; they're individuals. So that's something that could happen as well. Okay, and then there's evaluation, which I couldn't find a whole lot on that. I'm sure if it's in here, you guys will catch on to that. Hang on, I got a crying dog, so give me just a second here. I'm gonna mute this mic for 1 second. You might have seen my palmetto pin somewhere. That's okay. Where's he? Come here. Where are you? Yeah, this is the guy that was making all the commotion. There he is. All right, look into the camera over there. Yeah. He's my old boy. He was making a big mess, big crying a little bit. I could hear it. You might not could have heard him. I heard him in there grunting. He's like, "Come save me." Okay, so accounts payable, we got our relevant assertions, which is, again, completeness and cutoff, right? Completeness and cutoff for our two big assertions there. So let's get to how are we going to, what are we going to do? And it kind of goes into with what we do with cash and what we do with cash and accounts receivable, and we're going to do confirmations. We're going to confirm accounts payable with the people we owe money to. So it's going to be, how much, at the end of the year, how much do we owe you? Can you please confirm it? So we'll do confirmations. One thing in here, it's, when you're looking at the accounts payable to confirm, it's actually a good idea to confirm the smaller balances and the zero balances as well, especially if they have a lot of activity. Like if it's a vendor they use a lot and they're showing a zero balance, then that would be a good one to confirm. Stuff like that. So as opposed to accounts receivable where you really want to focus on the big dollar amounts, here it's not saying you don't want to ignore the material ones, but ultimately it's still important to analyze the zero balances or the very small balances as well. They still have a little bit of weight there. All right, so after we consider accounts payable, it gets into expenses. Okay, excuse me. And when we look at expenses, there are some similar assertions. When you look at expenses, there's 4 high risk assertions, and that is completeness and cutoff. I hear barking now, so you probably do too. Completeness and cutoff. Oh my goodness! Get out there! Go outside. He's gonna stand in the door and bark. Okay. Anyway, accounts payable. Hang on, I got this. Expenses. Hey! Let me go shush him outside. I'll try not to see where you can see my pants again. They're like palmetto flags. All right, let's see if we can get through this. Sorry about the distractions there. So we're talking about expenses. Our assertions there are, again, completeness and cutoff, just like they are for accounts payable. But also we have accuracy, okay, and then classification. So, with accuracy, you would think about, even when you go back to principles 1, you talk about inventory, okay. So if we're buying some inventory, obviously the cost of the inventory is easy. The vendor price or the invoice price is easy to figure out. But if we're doing, FOB shipping point, well, that means that we have to pay the shipping, and that would get included in the cost of, in the cost of inventory. Excuse me again. And also, if we're going to have insurance on the shipping, that would be included as well. What else? Taxes would be included in the cost of inventory as well. So there could be some stuff there with accuracy. Then classification. Here I start thinking about, okay, well, what about when you get into analyzing the repairs account for your vehicles potentially, or your machinery? Obviously, if you have a truck and you replace the brakes, well, that would be just a repairs expense. However, if you had to replace a blown engine, okay, well, that's probably going to extend the useful life and be a pretty large purchase, and would have to be capitalized with that truck, right? Because you're going to extend the useful life, and that's where classification can be a problem. Where, does it classify as expense, or do we need to classify as an asset and then depreciate it? Okay, that could be just one example of where classification could be important, right? Okay, so in this chapter, there is talk about payroll. It's one of our sections to worry about. Also, property, plant, and equipment, PP&E, property, plant, and equipment. Okay. The good thing about all these is there's going to be plenty of paperwork to back up the numbers. Okay, so let's think about payroll, right? So if it's payroll, if you find a paycheck, or how much you paid to John Smith, right, for the week of July 15th. Okay, well, we can go back to the source doc. We could vouch backwards to the time card. Okay, we can see that John Smith worked over the past 2 weeks, 78.34 hours. Well, we should be able to know his rate and recalculate pretty quickly and make sure that that check is done correctly. Okay, so the good thing about stuff like payroll is you should have plenty of data you need to recalculate and recompute those numbers to ensure that the process is working correctly. And also, when you talk about property, plant, and equipment, a lot of this stuff is pretty big dollar amounts. So a lot of times these large acquisitions will go through board of directors approval. So you'll be able to take it all the way back to the discussions in the minutes of the board meetings. You want to make sure, if it's like where you have, if you have assets being sold off, well, that should be approved by somebody. So you shouldn't just see, assets coming off without any rhyme or reason. So you should have a good chain of command where it says, okay, we're going to sell this. It's been approved by the board, and here's where we're selling it off, and here's the check for the proceeds for what we sold it for the most part. So a lot of documentation, and even with any other expense, okay, if you just want to check a power bill, well, you go back to the whole process. You start with here's the posting on the ledger, and we'll vouch backwards, and that's going to tell us that, hey, that when we get back all the way back to the invoice and to the requisition to pay the invoice, it's going to give us a good idea that that's a appropriate expense that actually occurred, right? Because you vouch for occurrence. And the good thing about this whole process is if you want to start backwards, start back at the actual purchase orders. Well, those are pre-numbered, so we know that none of the numbers have been skipped, right? So if we go find a selection of purchase orders, first off we'll scan to make sure there's none missing, okay, and then at that point we can we pick some to look at. We can start with the purchase order, get the invoice, because it should all be one big package. Here's the purchase order, here's the invoice, here's where we received it, and here's where we wrote the check. We also see that the invoice has been stamp paid, so we won't double pay it. Okay, you got everything to look at. And then once you've got all that pieces of the puzzle, you want to make sure you see that purchase order posted into the correct expense account, right? So you can do the full thing from starting at the original source documents and going forward to the trial balance, or the posting in the ledger, or you can start at the posting in the ledger and go back to the source documents. Okay, so if you start at the source documents, that's going to be tracing. If you start at the general ledger postings and go backwards, that's going to be vouching, right? All right. So the rest of the chapter, there is one thing I want you to try to probably should read real quick. What page is that on? Is that the one? On page, I think it's 350, there is a nice little chart you can look at. It's way too big for the screen here. 347s is one good one too. Okay, they got these charts like this. Can you see this? Not really, right? But these things here give a lot of information. I would definitely recommend going through and looking at these. So, like for accounts payable, when you look at the assertion of completeness, we want to make sure that we want to make sure that liabilities are. What can go wrong is we could have some non-recorded liabilities. And what we want to see, this is talking about the internal control activities. Receiving reports should be pre-numbered and used in order. And then you got all receiving reports completed by the end of the period should be accounted for in that period. So it's just a good list of what can go wrong, what's assertion are we testing, and what would we do to do testing of that assertion. Okay, it's in the book. I recommend it. Now we're going to look at 8 questions, and then I'll let you guys finish up. Now, I did post Chapter 8 quiz a few minutes ago for you guys to take care of, and also at some point, I think it's like 1 o'clock, I've already got it set up, but you can't see it until the time comes by. The Unit 3 exam will open up at about 1 o'clock, I think, and it's going to be due next week, so that'll be Chapters 6, 7, and 8. Is one assignment, okay? So let's look at these 8 questions. And now my dogs, now they want to come in, so 1 second. Okay, I left one outside. He's probably going to get mad here in a few minutes. We'll see. Let's do these questions, hopefully, without any more disruption. Okay, so the first question, number 1 here, is which of the following accounts does not appear in the acquisition and expenditure cycle? So before I look at the answers, remember, this chapter we're talking about stuff like cash, okay? There's going to be debits to cash, but still cash, accounts payable, expenses, obviously, but also you can have some of your fixed assets as well. So let's see what we got. Purchase returns. So in my principles one book, we don't even do purchase returns. Instead, we would just subtract it from inventory. But if you're dealing with purchase returns, those tie into inventory, so that I guess that would make some sense to be in here, or would it? Yeah, I guess it would. Okay, prepaid insurance, that would be if you've one of your debits. Okay, if you're buying insurance, you always prepay for insurance. The debit would be prepaid insurance, so that would be appropriate. This is really a Chapter 7 thing, so that's going to be our answer. Sales return, that ties into the sales chapter, which is Chapter 6. Accounts receivable, sales, and cash credits, or cash debits. And then cash is obviously here. We're talking about debits. We're talking about the cash disbursements journal, so this will be our answer. Okay. Number 2 here. Which of the following is an internal control activity that could prevent a paid disbursement voucher from being presented a second time? Okay, I know the answer without even looking at it, but one thing you want to be important here when you look at these answers is this word right here. Okay, we're talking about internal control activity, and it also needs to prevent. Okay, so with that in mind, some of these answers are probably going to be like after the fact, right? Well, it's already occurred, so we're detecting it, and that would not be the answer. So let's see what we got. Okay, here's our 4 possible choices, right? So the first one, the date on the disbursement voucher should be within a few days of the date the voucher is presented for payment. Okay, I mean, that sounds reasonable to me, right? So that sounds good. I don't see how that would keep it from being paid a second time. Prevent it from being paid a second time. So this one, I mean, if you're going to pay it twice, it would probably be, in the very, what we got here, your screen is covering a bit of the question. Oh, I see what you're saying. You don't need to see me anyway, right? Hey, not that. There we go. I can get small there in the top corner. You don't need to see me anyway. Okay. So, this is probably what you should do, but if you wrote the check and then you didn't realize it and you saw, hey, this was still due, you would write it again, so that wouldn't really prevent it. The official who signs the check should compare the check with the voucher and should stamp paid. Now, this is the one that I keep talking about a lot. I was talking about a lot in class, too. This is the recommendation that I made to the church as well, which was to go ahead and have a stamp on your invoices that says paid. That way there's just no chance of paying it twice. So that's going to be our answer. What's down here? Vouchers should be prepared by individuals who are responsible for signing the checks. That's just a normal activity, normal control activity. And then down here, disbursement vouchers should be approved by at least 2 responsible management officials. So these are just, 2 and 3, or 3 and 4 are just good internal control activities, but they wouldn't prevent double payment, okay? So this one here would, because you see that big red stamp, why are you paying this again? It's got the word stamped on there, paid, right? So it's just a very easy, simple solution to prevent double payments. Number 3, which of the following is the best audit procedure for determining the existence of unrecorded liabilities? Okay, unrecorded liabilities. I'll give you a second to kind of scan those answers real quick. So this first one, let's see what we got. Examine confirmation requests returned by creditors whose accounts are on the subsidiary trial balance for accounts payable. Well, we would do that. Okay. They should, obviously, if we sent them a confirmation, we knew they had a liability. So there would be no potential unrecorded unless it came back as there was a problem. Okay. Well, there's another guy. Number 2, examine unusual relationships between monthly accounts payable and recorded purchases. I mean, we should do that, but when you get to this one here, number 3 is going to be your answer. Look what it says. Examine a sample of cash disbursements in the period subsequent to year end. So after the year end, okay, maybe 15 days, a month after year end, if you were to look at your your cash disbursements journal, you should see a lot of credits to cash in there, where the other side would be a debit to accounts payable. So if you saw any weird things in there that, well, here's the cash payment and it was for accounts payable, but I didn't see this in our initial list, then that would give you an idea that there were some unrecorded liabilities at the end of the month. He's going to keep barking. I'm going to try to get through it, though. All right, number 4, which is following procedures is least likely to be performed before the balance sheet date. Okay, before the balance sheet date. Now, most of these you'll find out that from this list, the majority of them should be done at or after year end. Sometimes, if you have a really good control environment, you can do some of these before end and then come back right afterwards and just kind of wrap it up. But from this list here, what we just talked about in the previous question, you can't search for unrecorded liabilities until you get to that cash disbursements journal after the year end. So it's ultimately impossible to search for unrecorded liabilities until after the year end. And so that's going to be the best solution. But all of these, okay, confirmation of receivables, if we're going to send a confirmation, what did you owe us at November 30th and the year end is 31st, okay, well, we're looking at the year end on the trial balance, not the November 30th number. So most of these are better done at the end of the year. This one here really can't be done at the end of the year. Until the end of the year, I'm sorry. I misspoke there. All right. Curtis, a maintenance supervisor, submitted maintenance invoices. Curtis submitted maintenance invoices from their phony repair company and received the checks at a post office box. This should have been prevented. Okay, it's important by these 4 things, right? Which of these 4 things? Let's look and see. Now, obviously, this is usually where all are correct, right? Let me just hit that and go, but we gotta look at it, all right? So here's the first one: comparison of the company name to the approved vendor list by the signing. Okay, this one looks good. So this is probably going to be a yes, so this could still be the answer. Whenever you sign a check, it should be written to an approved vendor. Well, his fictitious phony repair company should not have been on the approved vendor list, and so this would prevent that from occurring. All right, good. Let's go to the next one. And if we can get this one here right, then we can know the answer, right? But anyway, recognition of the excess maintenance costs by Curtis's supervisor. Okay, now this probably wouldn't become of importance to the supervisor until after it's paid and it's been added to the expense account. So this would help figure out this fraud, but it would be a detective type of a thing as opposed to a preventative, okay? So this one will not prevent it, it will just detect it. So let's see what the third one here is. Refusal by the purchasing department to approve the vendor. Refusal by the purchasing department. Well, it looks like that would be good too, wouldn't it? Refusal by the purchasing department to approve the vendor. Ooh, now I'm not sure. I thought I knew it was the first one. Comparison of the company name to the approved vendor list by the check signer. Wouldn't that prevent it too, though? Let's try this one here. This is what I think it is. because they're not going to pay it, but it would be kind of far along the process. So maybe it's this one. I don't know. Might miss this one here. Let's see. Yep. What does it say? Oh, there we go. That makes sense. The check signer is probably not familiar with all the vendors. But if he was, and so I was close, but not quite right. I get it, but you see where I made my mistake, right? So this one's good. This one's not bad, but what they're saying is the check signer probably wouldn't realize that this was not on the approved vendor list. So it wouldn't have. So it should have got to him. But it should have been prevented earlier than that, and that's where I went astray. Okay, very good. When auditing the account balances of liabilities, auditors are most concerned with management's assertion about what? Okay, so I got that right. Accounts of liabilities. This is going to be this list here. And so it looks like according to my board. Here we go. Most concerned about cutoff and completeness. Okay, well, on this list, there's only completeness. Okay, so we'll just use that as the answer. These are all important, but completeness is the most important. All right. And here we go here. This is the same thing. Did I put it in there twice? I must put it in there twice. When auditing account balances for liabilities, auditors are most concerned about completeness. Okay, so I put it in there twice. And now we're at number 8. In a test of controls, auditors may trace receiving reports to voucher records in the vouching register. So it's completeness, right? I didn't mean to say that. But anyway, when you see tracing, this tells you the answer. Okay, trace. We do test of controls. If we're doing tracing, which is a form of document, examining documentary evidence, tracing is always going to be completeness. Okay, if it said something to do with vouching, it does say voucher register, but it's not. We're not vouching. It's just that the package is called the voucher package. If we were vouching, then it would be occurrence. Anyway, don't forget your question to go with the on the discussion board, which is here's the solution. It's also in the book, right? Your 5 assertions for accounts payable, and remember that the 3 at the bottom. I want you to put in there that the top 2 are the high risk ones. Okay, completeness and cutoff are the primary ones. Secondary would be valuation, existence, and this R&O. Remember, R&O is actually its obligations, right? Because the rights deals with assets, obligations deals with liabilities. All right, guys. If you guys can get the work done for me, you got a couple quiz. You got 2 quizzes due this week plus the exam. Make sure we get those turned in on time, and we will continue again probably let's go next Tuesday. So next Tuesday we will begin chapter. We'll look at chapter 9, which is the production cycle. So we'll be doing a lot of inventory and stuff like that. So you guys have a great weekend. God bless. And we will see you guys next Tuesday live.